Capital gains tax. Capital gains tax. So to define capital gains, it is when individuals sell off capital assets. Okay. So when there's a tax that has to be paid on the gains that arises on selling of a capital asset. So normally it's what we call the chargeable gains. So the chargeable gains is the difference of the proceeds, how much the individual got for selling the assets, and then you deduct the cost of the assets. That will result in the chargeable gains. So therefore, a chargeable gain or allowable loss will arise on when a chargeable disposal is made. Note the keywords. And the chargeable disposal is of a chargeable asset. So if you make a chargeable disposal and the asset involved is not chargeable, then the chargeable gain will not arise. And that disposal is made by a chargeable person. So a chargeable person making a chargeable disposal of a chargeable asset. That is what is required for a chargeable gain to arise for capital gain purposes. Okay. Now, what is a chargeable disposal? So this is when you sell your gift, you lose or have a property partly or wholly destroyed. Okay. So there's no when once the person dies, okay, there's no chargeable disposal, because when the person dies, it means that the asset has to be gifted to a close relative. So that does not qualify, or that does not fall under the remit of capital gains. It is when the person is alive and makes the sale, the gifting, loses or has the assets destroyed. Okay. A chargeable asset includes all assets unless those that are specifically exempted. We'll look at the exemptions very soon. So anything that does not fall within the exemptions is a chargeable asset. When you sell them, a chargeable gain will arise. A chargeable person is any individual that resides in the UK. Okay. And that person will be subjected to capital gains tax on any asset that they dispose of or they lose or gets destroyed within the UK and outside. That is a chargeable person. Okay. Let's look at assets that are not chargeable, non-chargeable assets. So motor vehicles are non-chargeable. Non-savings and investment certificates, they are non-chargeable. Government securities, what we call the gilt edged, are not chargeable. Qualifying corporate bonds, that is corporate loan stocks, are not chargeable. Foreign currency that is meant for private usage, they are not chargeable. Decorations that are given to people for acts of bravery. Somebody goes to war and is decorated with a medal, or somebody does something exemplary, a journalist or stuff like that, and they are given a medal for that. If the person sells it, it will not result in a chargeable gain. When somebody gets injured and is paid compensation, that amount the person receives is not going to be chargeable. Okay, somebody suffers an injury in the office or somewhere and then sues and get damage or is compensated. When somebody makes a life insurance policy and gets benefit out of it, that proceed, the amount that he or she receives from the insurance company, will not be chargeable. Any artwork that is meant for national usage will not be chargeable. Then certain chattels, we'll get to chattel very soon, it will not be chargeable. And then investment in individual savings accounts, when that is redeemed, it's not going to be chargeable. Is that understood, please? Let's look at how chargeable gain or loss is computed. Okay, so you first record the proceeds, that is the amount that was received from the sale of the chargeable asset. Then any expense that was incurred in the course of selling the assets. So you want to sell your building, then you contracted the services of an agent or a lawyer or a real estate company to help you to sell. You incur that expenditure because you wanted to sell. So you have to take that from the proceeds that you receive. Okay. Then it will give you the net proceeds. Okay. Then you deduct the cost of the asset. How much cost you incurred in owning that asset. That will be the acquisition cost. That is going to result in the capital or the chargeable gain. If the cost is more than the net proceeds, that will be a chargeable loss. Okay. Now, when a sale is made between people, let's say Gina makes a sale to the husband, we are deemed that it is not made at arm's length. Okay, especially if it is a gift. We don't think that maybe the item was sold to Gina or Gina sold the item to the husband at the market value. So that way, we will look for the market value of the asset and replace it with the actual disposal of the asset or how much the gift is valued. Okay. Now, disposal that is also made to connected parties. Okay. So that will also be taken at arm's length. So when a gift is made, you will look for the market value of the gift, and that will be the disposal proceeds. Okay. When disposal is also made between close relatives, as I said, Gina sells to the husband. We will look at the disposal proceeds of the asset. If it is not at the market value of the proceeds, how much the husband would have paid for if he had gone to the market, then we will substitute the market value for the actual sales price of the assets. Okay. Now, selling expense, as I mentioned, is the incidental cost of disposal. So, auctioneer's fees, estate agent's fees, valuation fees. You want to sell the asset, a building. You need to know how much it actually costs so that you don't under or overprice it. If you want to advertise the building in order to get proper patronage, that will also be incidental cost, legal cost as well. So these will be deducted from the disposal proceeds to get the net proceeds before you deduct the acquisition cost to get the capital or the chargeable gains. And if it is lesser than the cost, it becomes a loss. Okay. Now, in as much as there are certain expenditures that can be deducted, there are certain expenditures that will be deducted from the proceeds. Okay, we are talking about the acquisition cost. Let's look at what goes into the acquisition cost. It's not every item that will be permitted to be less from the net proceeds. So when we talk about the acquisition cost, we are talking about how much the individual actually paid to own the asset. So this will include the purchase cost. And if the asset was not purchased but it was inherited, we'll look at the market value of the asset when the owner died, the person who made the gift, when he or she died, the market value, not when the owner bought the asset. It is when the asset was gifted. We'll look at the market value of it. Now, if the asset was received as a gift, the market value at the date of the gift is when we use. So in the point of inheritance, even if the person died 2 years ago and the estate was shared now, we're not going to look at the market value when it was gifted. It will be when it was inherited, when the person died. Okay. Now, for gift, it is when the asset was received. That is when we use the market value. The second component of the acquisition cost is when an amount is incurred to enhance the assets. That is what we call the capital expenditure. So you have the building. The building is a 2 bedroom house. Then you extend it to 3 bedroom. Or the building doesn't have any heater. You include a heater. The building is not tiled. You tile it. That is cost to enhance the asset. That will lead the asset to increase in value. Okay. That will also be included in the cost. That's what we call the enhancement cost. Okay. Any question? Any questions so far? Hello? And people, are you there? Okay, okay. Gina, are you okay? Big Ben. Okay. Let's look at an illustration. A chargeable asset was disposed of for £10,000. Now, on disposal, £1,000 of legal cost was incurred. The asset originally cost £5,000. So, which of these assets will be classified as incidental cost of disposal? Which of these costs will be classified as acquisition cost? And then we are supposed to calculate the chargeable gain. So, now the proceeds that was received from the sale of the asset, we are told is £10,000. Then he incurred legal cost. So this thousand will be incidental cost of sale. So selling expenses. That is the legal cost. We less it £1,000, which will give us the net proceeds of £9,000. Now, if you are supposed to less the acquisition cost, okay, we are told the asset originally cost £5,000. Okay, so we were not told any expenditure that was incurred necessary to own the asset. So if you're going to buy a building, it is essential you get a lawyer to look to the document to ensure that the asset is not belonging to another person and is being sold fraudulently to you. So the cost of the lawyer services will be incidental cost of purchase. Okay, it can be cost of purchase. If you're buying a land, you have to do a search and all that. If you're buying a vehicle, you need to check. So here we only have incidental cost of disposal, which is the £1,000. We don't have incidental cost to sell. So if we had, we would have included it in the acquisition cost. So here, the chargeable gain, because the proceed is more than the cost, is going to lead to a chargeable gain of £4,000. Are we okay? Are we okay, please? Let's look at another illustration. On 1st May 2010, a man acquires a piece of land for £10,000. On 1st May 2023, he transfers it to his daughter when the market value of the land is £100,000. So you're supposed to calculate the chargeable gain, the proceeds, which will now be the market value at the date of transfer. Okay, is £100,000. Okay, then the acquisition cost is £10,000. So here we don't have any incidental cost to disposal or to purchase. So here the chargeable gain will now be 90,000 on the father. Is that okay, please? Yes, please. Are you okay? Okay. Now, we've looked at how to compute the chargeable gains. Let's see how the capital gains tax. This is the taxation class, so we are interested in the tax. But we first have to estimate the gain that will be liable to the tax before we proceed. So, when you are looking at the tax, and an individual has numerous property, numerous assets. So let's say Gina has a car, she has a land, she has buildings, she has maybe jewelry. If she sells these items, we'll estimate the gains or losses on the assets individually, separately. We're not going to put all of them together and then estimate it. So we'll estimate the gains or losses on the jewelry, estimate the gains on losses on the land, estimate the gains on losses on the building, estimate the gains on losses or maybe the car. Okay. So when we are done, okay, then we can put them together. Okay. So what we'll do is that we'll look at the capital gains tax in the year. Okay. So if, let's say, for the car, when she sold it, she made a gain. When she sold the jewelry, she also made a gain. Let's say when she sold the building, there was a loss. Okay. And maybe she had a phone, was also a loss. So the capital gains for the year will add these two. Then these losses will be deducted from the gains that has been estimated. Okay. Then it will result in the chargeable gain for the year. So if, let's say, this gain was 10,000, this gain was 5,000, this loss was 3,000, and this loss was 2,000. Okay. The chargeable gain here will be 10,000. The loss will be 5,000 here. Then it will result in a chargeable gain of 5,000. Okay. If the losses are more, then it will be a chargeable loss. Nothing will be surcharged. Then we have an annual exemption for capital gains. And for the tax year 2023-2024, it is 6,000. So if you remember, when we're talking about the trading losses, we mentioned that if the trader, the self-employed, wants to offset any outstanding trading loss against the capital gains for the current year, the loss cannot be restricted to save the annual exempt amount. That is the annual exempt that we're talking about. So it's either he or she decides that she is charging the loss against the current year, for which it will take precedence over the annual exempt, or enjoy the annual exempt against the capital loss and then move the loss to another year, or either forward or back. So there's an annual exempt amount. So once that is done, then that is going to give you the capital loss, the capital gain or loss. Then if you have any capital loss being brought forward, you deduct. And also the capital loss, we mentioned that if it is coming from the previous year, that one you can enjoy the annual exempt before. But in the same year, that will take precedence over the annual exempt. So you see that the losses that we enjoyed, we have to take them out from the gains before the annual exempt. Okay. So if you have a loss in this current year, so assuming that the loss here was 10,000, the gain was 10,000, but the loss was 15,000, we are going to get a loss here, meaning we'll waste the annual exempt because you cannot move it forward. Okay. Once you waste it, this loss can be moved forward to the subsequent year. But in case this loss is being taken to the next year, then the annual exempt can be taken before you charge the loss in the previous year. Okay. So that will give you the taxable gains. So after you get your net gain for the year and you deduct your annual exempt and you deduct any loss that has been brought forward, it'll give you the taxable gains. So this is what you're going to apply the tax on to get your tax liability, capital gains tax liability. So for this year, the capital gains tax is 10%, 20% for non-residential buildings, and 18% and 28% for residential buildings. Okay. So let's talk about the annual exempt. We'll get to the tax very soon, so don't worry. For the annual exempt, it is an amount out of the gains that will not be subjected to capital gains tax. So this is similar to the personal allowance that we see in the income tax computation. So you calculate your taxable income, and then an amount, you calculate your net income or your total income, and then an amount is exempted from being taxed before you get to the taxable income. The same thing with capital gains tax. You get your chargeable gains, then an amount is taken out before you get to your taxable gains. So as I mentioned earlier, for the tax year it is 6,000. Okay. Now, any amount that is not used in the current year is wasted. It cannot be transferred. So if you have a net gain of 5,000 and you are unable to use the 1,000 as share, you can't transfer it. Okay. Any question on the annual exemption? Any question? Employment allowance, which one? For the class one, the class one secondary. That one you can't carry it. That one you cannot carry it forward. A personal allowance you can't carry it forward. You can't carry it forward. Yes. All right. Let's look at the capital gains tax rate. So before you start charging capital gains tax, the rate that you want to use, you first need to check the the category that the individual falls in. Is the individual a basic rate taxpayer? Is it a higher rate taxpayer? Or is an additional rate taxpayer? So if the individual, okay, is a basic rate taxpayer and has some balance, okay, in the basic, then the rate will be 10%. So the basic rate we know is 37,700. So if the individual's taxable income in the income tax computation, let's say is 17,700, it means that there is a balance of 20,000 in the basic rate. Okay, so if the individual's chargeable gains is, let's say, 25,000, you can charge 20,000 out of this at 10%, and then you charge the rest of the 5,000 at 20%. That is if it is a non-residential building. If it is a residential building, then the difference of the 37,700 and the taxable income, which is 20,000 here, will go at 18% at the basic rate. And in this scenario, the excess, which is 5,000, which falls in the higher rate, will go at 28%. So the same thing that we did for the savings income and the dividend income. We check whether there is an amount left in the basic. Then we charge that at 10%. Then the amount that is falling in the higher rate, that goes at 20. For residential building, the amount falling in the basic, okay, we charge that at 18. Then the amount falling in the higher rate goes at 28%. Okay. Now we have something we call the entrepreneurs relief or basic asset disposal relief. Now this is taxed at 10%. Okay. And for one to qualify for it, it is necessary they meet some criteria. Is that clear, please? Is that clear? Can we continue? Can we continue, please? Okay. Please give me a minute. I'll be back. Okay, let's look at this illustration. Catherine Catherine has a trading profit of £45,000 in 2023-2024. Additionally, she sold a capital asset, giving rise to a taxable gain of £15,000. What is her capital gains tax payable for 2023-2024 be? Again, please take note of the key terms that are being given. She has a trading profit of 45,000. She has a taxable gain of 15,000. We are being asked of capital gains tax payable. Okay. So once she has a trading profit, then we now have to calculate her taxable income. So for Catherine, her taxable income, trading profit is 45,000. Then we have to less personal allowance of 12,570. That is what will give us the taxable income. What are we getting, please? Hello, are you with me? Hello. What is the difference of 45,000 and 12,570? So you're having 32,430. Okay. Now, we are being told that she has a taxable gain. So we are not now going to calculate the capital gains tax. She's already done the difference between the cost and the proceeds. Okay. So in order to calculate for the taxable gain, the tax payable, capital gains tax payable. Okay. We'll first look at the basic. For the basic, we have an amount 37,700 less the 32,430. This one. What will be the difference? No, we're saying that we have to determine the taxable income of the individual. That will tell us how much basic we have to know. So we have calculated the taxable income. They only give us trading profit. So we needed to calculate the taxable income and then know the difference outstanding in the basic. So what's the difference between these two? So 5,270. That will go at 10% because it's not a residential building. So it means that we are getting £527. Okay. Then the higher rate, the taxable income is 15,000. So it is below the higher end of the higher rate. So we don't have to bother. So it will be 15,000 less 5,270. Okay, that will go at 20%. So what is 15,000 less 5,270? 9,730 at 20%. 1,946. So the capital gains tax payable is, please give me the sum of the two. 2,473. Okay, this is the capital gains tax liability, and we are not told whether she has paid any again, so it should be the same as the payable. Okay, if they are told us that out of this she had paid £1,000 already, then the payable will be this amount less 1,000. But because we don't have any information about a tax previously paid, the liability will be the same as the payable. Okay. Any question, please? Any question? Hello, Gina, Ben, are you following us? Are you okay? Ben, okay. Let's look at another illustration. Matthew has a taxable income of £20,000 assessed in the tax year 2023-2024 and sold an antique vase, giving rise to a capital gain of 18,300. We're supposed to calculate Matthew's capital gains tax for 2023-2024. Now, in this question, we've been given taxable income. It means that the income that he had, whether it was employment or trading or non-savings, the personal allowance has already been taken out, giving rise to £20,000. Okay, so once we have the taxable income, to be £20,000. Okay, here also we are told that it was a capital gains that arose, not a taxable gain. In the previous question, it was a taxable gain. So once there's a capital gain is normally the proceeds. Okay, so you had a proceed and there was a cost. We less the cost and now we are getting the gain. So the gain now is the 18,300. We now have to learn the annual exemption amount of the 6,000, which will now give us 12,300. So this is the chargeable gain or the taxable gain. Do you get it, please? So you have to watch the wording very carefully. They give us taxable income. They've given us capital gain. So we now have to take away the annual exempt amount from it and get the chargeable gain. So this is what we pay the tax on. So when we come here, the taxable gain is 20,000, meaning there is 17,700 left. So for the basic, we'll have 17,700 left in the basic. Meanwhile, the chargeable gain is 12,300. So for the capital gains tax, is going to be 12,300 at 10%, which will be 1,230. Do we understand, please? Hello. So here we were given taxable income. Taxable income means that the total income, whether it was employment, whether it was a trading, whether it was property, whether it was interest, whether it was dividend, that have been summed and the personal allowance has been taken out of it. So that gave us the taxable income. So that is what we compare to the basic rate or the higher rate to check the outstanding difference. In the previous question, they gave us just a trading income. So we had to proceed to deduct the personal allowance to now get the taxable. So it is taxable that you compare with, not the trading. Okay. So now with the capital gains, the previous one they gave us taxable gain. Here they gave us taxable gain. Taxable gain is when you get the capital gains, you have the proceeds, okay, and you have the costs. This gives you the gain. This gives you the capital gain or the chargeable gain. Okay. When you less the annual exempt amount of 6,000, that gives you the taxable gain. Okay. That is what you apply the tax on. So in this question, they gave us taxable gain, meaning the annual exempt has been already calculated. That is how come we just pick the figure and found the difference in the basic and start applying it. Here, we have been given capital gains. So it means that we've been given up to this point. So we now have to proceed deducting the 6,000 out of it to get the taxable gain before we apply the rate. That's how come we took the 6,000 out of this place. Okay, and we got the taxable gain. Is that clear, please? So once we get a taxable gain of 12,300, then the taxable income was 20,000. It means there is 17,700 left in the basic band, which is 37,700, less the 20,000 above. Meanwhile, the amount of taxable gain is less than the balance of the basic rate left. So the entire amount will go at 10%, which is 1,230. Is that okay, please? Gina? Okay. Let's look at another illustration. Ike sold a residential property which resulted in a chargeable gain of £40,000. Peter has a taxable income of £20,000. You are supposed to calculate Ike's capital gains tax. So in this one again, this time around too, we've been given chargeable gain against taxable income. So taxable income of £20,000. We have chargeable gain of 40,000. Then annual exempt amount 6,000 will go, leaving a taxable gain of 34,000. Sorry, 34,000. Now, when you come to the basic rate, because the taxable gain is 20,000, the basic rate they will be left with a balance of 17,700, which is the 37,700 less the 20,000. So because the taxable gain is more than the 17,000 outstanding, the basic will be 17,700 at 18% because it is a residential property. 18%, which will give us what is 18% on 17,700, please? It's 3,186. Then the next one, the difference, which is 34,000 less 17,700. That will go at 28%. So what's the difference here? The higher. What is that giving us? So you have 16,300 at 20%, at 28% to give us 4,564. So the total capital gains tax will give us so you have 7,750. Is that okay? Are we okay, please? Yes, please. Ben, are you okay? Okay. So this one is easier than the income tax. Eh? Let's look at when capital gains must be made. The payment must be made. So it is normally supposed to be paid the 31st January following the tax year. Okay. So for the tax year 2023, 2024, we are supposed to pay it by 31st January 2025. Because normally the tax year 2023, 2024, it will end on 5th April 2024. So the 31st January following it is the 31st January 2025. Okay. Now, when a residential property is disposed of, there must be payment on account that has to be made. So then the payment has to be made within 60 days of the disposal, when the disposal was made. Okay. Okay. So when you make the disposal 1st January 2024, 60 days is around March, end of March, or getting to the latter part of March. You have that period, or end of is early part of March. 60 days will be around early part of March. So you have to make that payment within that period. Okay. Now, for payment on account, the calculation is that you have a residential property when you sell it, the gains that you make. Okay. Then, if there is any current year capital loss before the residential property was sold, you have to deduct it. Then, if there is any capital loss brought forward, you also deduct it. Then you deduct the annual exempt amount, the 6,000. That will also go off. Then that will result in the taxable gain for the residential property. Then you tax it at 18% if it falls in a basic category, or 28% if it falls in the higher. Okay, so this is the payment on account. Payment on account is you are paying the tax as and when you make the sale. Then at the end of the year, you estimate your tax. Then you deduct the payment. So at the end of the tax year, okay, at the 31st January 2025, you don't have to calculate your entire capital gains tax liability. So let's say if you sold a residential property in the middle of the year, after the middle of the year, you made other sales, or you sold a residential property, but there were some non-residential property that were sold before or after. So you accumulate all your sales, your capital gain sales, your capital disposals. You get your liability. Then you deduct the payment on account, the one that you have made here. If there is an excess or if there is an amount outstanding, then you pay it. If the payment on account is more than the capital gains that you have estimated, that will be refunded to you from the HMRC. Okay. Now, you see that we assign the annual exempt to the residential property. That is a tax strategy. It's a prudent tax measure because the non-residential property are going at an exemption rate are going at a tax rate of 10% and 20, whereas the residential property is going at a rate of 18 and 28. So it's best you assign it to them so that they reduce the liability further. Okay, something that is going at 10%, an impact will be lesser than something that is being charged at 18%.